Hello and welcome to Growth Infinite. In today's topic we explain whether Indian banks are on solid ground or we should fear a Silicon Valley Bank type collapse. If you heard a story of a Silicon Valley Bank crisis, the first half of this story will sound quite familiar to you. But since we're talking about banks, we have to explain some of these concepts. We are gonna break this story into two parts. Part 1. The Model C banks have a simple business model. They take deposits from people like us and pay us low rate of interest. They then lend most of these deposits out to others and earn higher rate of interest. The difference between this deposit rate and the lending rate is their margin. They make a decent chunk of money this way, but not all of the money gets doled out as loans. They set aside some as cash just to be safe in case of a crisis, and the rest of the money is invested in things like government bonds. It's a relatively safe investment. Let me not on them the big box, but they can sell these bonds quickly in case of an emergency, but things could go wrong. The folks who borrowed money might default, or the investment could turn out to be duds and create losses. When people see this happening, they could panic. They could rush to withdraw their money from the bank to keep it safe. It's called a bank run, and banks will have no choice but to use the cash they've kept aside for emergencies. They might have to sell their bond investments too. No, depending on the economic environment, this could be a bit of a problem because bonds are wired a little differently. The price of a bond and its yield, which is another word for returns, move in opposite directions. The reason is actually simple. Imagine you pay 100 rupees and buy a bond and you get 5% interest or yield on it, and now imagine the central bank raises interest rates. They issue new bonds at 7% interest. Suddenly the bond that gives you 5% is not attractive anymore. People like you who brought it would rush to sell it. You would rather put money in the new 7% bond. Now you know that when people sell it, the price takes a knock, and let's say that the price of a bond fall to 98 rupees. Suddenly investors realize the bond is available at a discount of 2%, benefit from the discount and also get the 5% promised interest. Basically, as the price falls, the overall yield rises and vice versa. And in an environment like today, when central banks are busy raising interest rates to curb inflation, it has a negative impact on all the bond investments made by banks. But to how the Indian banks placed. Now that the primer is over, let's focus attention on Indian banks. So the first thing to address is a bank run. It's something that happened at Silicon Valley Bank and Credit Suisse, but also you must know that such events don't happen every day. Rather, there was something that made these banks especially vulnerable. The kind of clients they cater to. You see, SVB or Silicon Valley Bank had raised a lot of deposits from startups, and Credit Suisse had a lot of extremely rich clients, as Bloomberg put it. Both of these segments are quick to follow the herd. If they see their peers pulling out money, they will rush to do the same thing. Money will flow out quickly, and that puts pressure on the bank. What if you look at how most Indian banks raise money? It's from households. Over 60% of the deposits are from people like you and me. These deposits are typically what you would call sticky money. It's not as prone to flights of despair. Sure, households will still panic, but the probability of this happening is less, according to the experts, or as the Journal of Economic Perspectives put it, bankers are being hard to joke. That a depositors was more likely to get divorced than to switch banks, so the deposits seem fine. What about the investments? Aren't rising interest rates bad for Indian banks? Not exactly. In fact, it's quite a good thing initially. Yes, we know this sounds a bit confusing, since all this while we spoke about how the bonds that banks invest in suffer from losses. Very interest rates rise, right? And that part is still true, but there are a couple of nuances here. Firstly, you need to understand how the bonds themselves are split in Indian banks. Typically only around 20 to 30% of the deposits that banks raise are set aside for these type of investments, and these bond investments show up in three ways in banks' books. 1. Held for trading, or HFT. 2. Available for sale, or AFS. 3. Held to maturity, or HTM. The labels are quite self-explanatory, right? Let's look at HFT and AFS first. Now, if a bank has invested in bonds for the purpose of trying to bet on interest rate movements and make a quick buck, They will have to classify that under HFT, or if they bought bonds just for a bit of safety knowing that they can sell whenever they need to, whether in 6 months or 2 years, they bucket in the AFS category. And the thing with the HFT and AFS categories is that because bonds can be sold at any given time, the RBI has told banks that the value must be marked to the market. This is just a jargon in heavy way of saying that if you buy a bond of 100 rupees and it falls to 98 rupees, then you must reveal that loss in your financial statements. On the other hand, the HTM category simply means that a bank can buy a bond with the intention of never selling it. They will hold onto it for life till it matures on its own. And when Jefferies Group crunched the numbers of the largest banks in India, they found that over 75% of these bonds investments are typically in the HTM segment, except Kotak Mahindra, which is only 45% store away as HTM. So at the moment, this means even when the central bank increases the interest rates in the value of bonds traded in the market falls, banks don't need to worry about the HTM portion. They don't need to show these temporary losses in their books. They can simply say, look, we bought these bonds for 100 rupees and these bonds will mature in 5 years. When it does, we'll get back what was promised. We aren't planning to sell any of it before maturity anyway. This way they can just keep showing the 100 rupees value on their books even if the bond changes hands in the market at a lower rate. And if there is no loss in the books, investors won't be too worried now, even if the rules around HTM changes and it has to be marked to market. Jefferies Group thinks the impact won't be catastrophic for banks. There's one more thing. A few years ago, the RBI told banks to play it safe during the good times when interest rates fall and banks sell bonds, other AFS and HFT to reap profits. They need to set a bit into an investment fluctuation reserve, or the IFR, the money is in this reserve, will be a shock absorber during times like today when interest rates head north and bonds lose value. It's smart, right? Secondly, we need to remember that over 60% of the money that bank raised deposits are given as loans. It would be to people like you and me who needed long-term housing loan, or to corporates so looking to expand the manufacturing, maybe build a new plant or two. Banks are smart. When the interest rates are hiked, they rush to reprice these loan rates quickly. They don't waste time, because time is money. On the other hand, they don't raise rates on deposits that quickly. They take their own sweet time because they don't want to pay out of higher interest to us. They want to make hay while the sun shines, so there's a lag between loan rates and deposit rates. That extra money shows up in the margins of banks. For instance, ICICI Bank's net interest margin, or NIM, rose from 4% in June 2022 to 4.7% in December 2022. Kotak Mahindra Bank's NIM jumped from 4.9% to 5.5%, and State Bank of India's NIM inched north from 3.2% to 3.7%. Put these two things together and you will see why rising interest rate doesn't affect Indian banks too badly, at least initially. What is still a speed bump that banks have to deal with. Thanks for listening. See you in next one. Make sure to subscribe to our channel Growth Infinite.